you already know that artificial intelligence is driven by chips, right? We hear about the GPU bottleneck constantly.
Oh, constantly. It's all anyone talks about.
Exactly. But what if the real constraint on the future of AI isn't the silicon brains, but, the optical nervous system connecting them?
The glass.
The glass. Today, we are diving into an unprecedented global scramble for optical fibers and networking equipment. We're going to unpack this massive stack of sources today. We've got financial data from MarketBeat, global supply chain reporting from 36KR, McKinsey projections, and equity research from CMB International and Serenity Analysis.
It is a phenomenal shift in capital allocation.
Yeah.
Because when you look at the sheer scale of the infrastructure being deployed right now, it becomes clear that we are attempting to build something the physical world just isn't quite ready for.
Right, and to really understand where we are today, I think you have to trace the rolling bottlenecks over the last couple of years.
Sure.
Okay, let's unpack this. In 2024, everyone remembers the chip shortage.
Yeah, you couldn't secure a high-end GPU for any amount of money.
Exactly. And then by 2025, the bottleneck had moved down the line to power. Specifically, high-voltage transformers were suddenly in short supply globally.
Right, because developers realized these AI clusters basically required the electrical grid of a small city.
Yes, exactly. And now, in 2026, the supply chain data points to a massive global optical fiber drought.
And the McKinsey projections on this lay out the mathematics of the problem perfectly. So the bottleneck stems from the fundamental nature of large language models.
Okay.
These AI training workloads require massive parallel processing. So you have, tens of thousands of GPUs that need to talk to each other simultaneously.
Right.
If the optical link connecting them is slow, your $30,000 GPU just sits there idle, waiting for data.
Which is a massive waste of money.
Huge waste. So to prevent that latency, hyperscalers are demanding networking transceivers capable of 800 gigabits per second and increasingly 1.6 terabits per second.
But the manufacturing simply isn't there to support that appetite, is it?
Not even close. Production for 800 gigabit transceivers is projected to fall 40 to 60% short of demand through 2027.
Wow. 40 to 60%.
Yeah, and for the 1.6 terabit generation, we are looking at a 30 to 40% shortfall persisting all the way through 2029.
So we're staring at a multi-year deficit for the exact components needed to make these AI data centers functional.
Right, which naturally just detonates the pricing models for the raw materials.
Oh,
When hyperscalers realize they might be left empty-handed, panic buying sets in and the cost of the underlying glass skyrockets.
Yeah, and the pricing data from the 36 carrier supply chain reports is staggering. Since January, the American G.657.A1 bare optical fiber has jumped 69%.
Yeah.
In Europe, that same fiber surged 130% in just 2 months. But the most revealing metric is the domestic Chinese G.657.A2 fiber.
Oh, the A2, yeah.
Right, prices went from 32 yuan per core kilometer last year to 240 yuan today.
It's incredible.
That is nearly an 8-fold increase. And there is a very specific engineering reason why this particular A2 fiber is commanding that insane premium, right?
Yeah, it comes down to space and physics, basically. AI data centers are incredibly dense. You are packing hundreds of thousands of cables into server racks where every single square inch matters.
Right.
But standard optical fiber has a fatal flaw. If you bend it too sharply, the light literally physically leaks out of the glass core, which destroys the signal.
Oh, wow. So it just bleeds out.
Exactly. But the G657.A2 specification is a bend-insensitive fiber. It uses these highly specialized trench-assisted glass designs to trap the light even when it's tightly coiled.
Okay, so without that specific bend-insensitive glass, modern high-density AI server architectures literally just cannot be wired together.
They can't, and the major players know it. Meta recently spent $6 billion to secure early fiber supplies just to lock out their competitors.
$6 billion just to cut the line.
Basically, yeah. Meanwhile, Microsoft is deploying 15,000 kilometers of hollow core fiber.
Hollow core fiber is fascinating to me because instead of a solid glass core, the light travels through literally an empty channel of air running down the center of the fiber.
Right.
And since light travels nearly 30% faster in a vacuum or in air than it does in solid glass, they are shaving off microscopic fractions of a millisecond in latency.
Which is everything in AI.
Yeah, I mean, if you think about it, building AI data centers right now is like buying a million state-of-the-art race cars, but realizing your entire transit network is a single-lane dirt road. The GPUs are the cars, but the optical fibers are the highways, and the industry is just frantically scrambling to pave more lanes.
That's a great way to put it. And to put numbers to that highway analogy, an AI data center requires 5 to 10 times more optical fibers than a traditional cloud storage data center.
5 to 10 times more.
Yeah, we are talking about tens of thousands of core kilometers for a single facility. And you can't just flip a switch to meet that demand. Because the manufacturing process for optical fiber is incredibly slow and capital intensive. Before you can draw the thin fiber, you have to manufacture a preform.
A preform, okay.
Yeah, it's a massive, highly pure glass cylinder created through chemical vapor deposition. Expanding a preform facility to actually scale up production takes anywhere from 18 to 24 months.
Wow. Okay, so if you're listening to this and you're an investor or just someone tracking the infrastructure space, you have to be asking yourself, if it takes 2 years to spin up new capacity, who holds the keys to the existing supply? Like, who actually controls the glass?
Right, the million-dollar question.
Or multi-billion-dollar question. And the global purchasing data points overwhelmingly to the Chinese manufacturing sector, which currently holds over 60% of the global optical fiber market share.
Over 60%.
Yeah. And the landscape is dominated by what the 36 Key reporting calls the 4 outstanding optical fiber enterprises.
And their evolution really explains how that massive consolidation happened. Take Yangtze Optical, for instance. They are the largest player today, recently hitting a 200 billion yuan valuation. But they actually started back in the 80s as a joint venture with Philips, trading domestic market access for Dutch technology.
Oh, interesting.
Yeah, and when they eventually faced technology transfer restrictions, they were forced into super aggressive independent R&D. That forced self-reliance compounded over decades, resulting in 33 consecutive years of profit and just absolute massive scale.
That's wild.
Yeah.
And Zhongtian Technology has a similarly crazy trajectory, right? I read they originated as a struggling brick and tile factory in Rudong.
Yeah, literally a brick factory.
And the leadership pivoted out of construction materials and into optical cables, eventually carving out this massive niche in deep-sea armored cables.
Exactly.
And then you have FiberHome, which operates as the state-backed national team player. Their big advantage seems to be total vertical integration. The supply chain reports literally describe their operation as from sand to system.
Right, so they don't just manufacture the silicon dioxide preforms, they build the end-to-end communication network solutions. That gives them immense leverage in large-scale infrastructure deployments.
Yeah, from the raw sand all the way to the final network.
And that vertical integration is a massive moat when global supply chains are choking on raw material shortages. They have completely shielded themselves from upstream bottlenecks.
Okay, but I do want to introduce some friction here, push back a little bit on this narrative.
Sure.
Because if these 4 companies control 60% of the volume, the 36 Key report also mentions that century-old Western companies still dominate the absolute high-end market. You look at America's Corning, which is 175 years old. Doesn't this create a massive geopolitical tug-of-war for you, the investor, watching this AI infrastructure race unfold? You have raw volume dominance in the East, but you have this legacy high-end intellectual property in the West.
What's fascinating here is that you've accurately identified 2 distinct battlegrounds in this race. The volume game is about laying millions of kilometers of physical groundwork, and the Chinese manufacturing base has an undeniable lock on that scale.
Right.
But the innovation game happens at the endpoints of that glass. The fiber itself is entirely passive. It's just a conduit. The real intellectual property battle is over the highly specialized components that actually beam the light through them, like the transceivers and switches.
Right. The things that actually light up the dark fiber.
Exactly.
Which perfectly transitions us to the equity research from Serenity Analysis. Because they provide this deep look at a company called Lumentum, L-I-T-E, which is operating right at the center of this endpoint battle.
Yeah, they are a huge player here.
The analysis ties Lumentum heavily to Google's build-out of their custom AI silicon, the TPU v7, codenamed Ironwood. Google is aggressively trying to build a parallel hardware ecosystem to break away from NVIDIA's GPU dominance, right?
Right.
And a critical pillar of Google's strategy is this unique networking architecture called Apollo, which relies on optical circuit switching, or OCS.
Yeah, and OCS is a radical departure from traditional networking.
How so?
Well, in a standard data center, data travels as light through the fiber, but when it hits a network switch, it has to be converted back into an electrical signal to be routed, and then converted back into light to continue on.
The optical conversion.
Exactly, and that conversion introduces latency and consumes massive, massive amounts of power.
Right, because of the heat.
Yeah. But Google's Apollo architecture uses microscopic mirrors, microelectromechanical systems, to physically bounce the light beam to its destination without ever converting it to electricity.
Wow. So it's essentially a highly advanced periscope system at a microscopic scale, just bypassing the electrical bottleneck entirely.
That's a perfect way to visualize it.
And Lumentum is the primary beneficiary of this bespoke architecture. Their fundamentals reflect it, too. I mean, 2025 revenue hit $2 billion, which is a 21% year-over-year increase, and they've returned to positive net margins.
Yeah, they're looking very strong there.
Because Google's OCS is custom-built for their hyperscale environment, Lumentum faces way less commoditization pressure than the standard transceiver market.
Right. They've effectively secured a monopoly within a specific, highly lucrative hyperscaler ecosystem.
But here's where it gets really interesting, and I have to push back again. The Serenity analysis flags Lumentum as having a beta of 1.48, meaning it's highly volatile and deeply sensitive to market swings.
Extremely volatile, yeah.
If Lumentum's success is this tightly coupled to Google's bespoke TPU, aren't they incredibly vulnerable if the broader market decides to just stick with standard NVIDIA GPUs instead? Like, if NVIDIA's standards win, Lumentum's bespoke moat suddenly looks like a trap.
It is the ultimate high-stakes architectural bet. I completely agree. You aren't just betting on Lumentum's execution. You're basically betting on Google's ability to convince the industry to adopt its parallel ecosystem.
Right.
However, if we look at the demand metrics, they provide a counterweight to that risk. The research notes that if major AI developers like Anthropic, Meta, or Apple adopt Google's TPU infrastructure for their massive inference workloads, Lumentum's addressable market scales exponentially alongside them.
Okay.
And right now, the supply constraint is so severe overall that Lumentum's production capacity is reportedly completely sold out into 2029 anyway.
Sold out until 2029. That's unbelievable. Now, if you think Lumentum's architectural risk creates volatility, the financial battlefield surrounding Applied Optoelectronics, or AAOI, is on another level entirely.
Oh, absolutely.
The financial data from MarketBeat paints a picture of a stock where Wall Street is literally waging a financial war.
It is genuinely rare to see institutional sentiment this heavily fractured on a single equity.
Right. Because on one hand, AAOI's Q1 revenue grew an explosive 51.3% year over year. In the hardware space, that kind of top-line growth is stellar.
It's incredible growth.
But on the other hand, they missed their earnings per share estimates, posting a 7-cent per share loss.
Yeah.
So they are scaling revenue massively, but they are still bleeding cash on the bottom line.
Yeah.
And when you combine that with the insider trading data, where company insiders, including the CFO, have been liquidating large blocks of shares, the optics get incredibly messy. Now, I know these sales are filed under standard Rule 10b5-1 pre-arranged trading plans to cover tax obligations, but let's be real. Retail sentiment rarely cares about the nuances of tax filings when the company is missing EPS targets.
Exactly. And that combination of top-line growth and bottom-line vulnerability is just absolute blood in the water for institutional short sellers.
Oh, totally. As of June 30, 2026, 13.93% of AOI's entire public float is sold short. That's 10.75 million shares betting on a collapse, marking a 5.1% increase in just 1 month.
Yeah.
Yet, staring right at that downward pressure, Rosenblatt Securities reiterated a massive buy rating with a $220 price target, implying a 36% upside. So what does this all mean? With a short interest ratio of just 0.8 days to cover, if AOI announces a sudden massive order from a data center, how violently could this stock swing?
If we connect this to the bigger picture, it explains exactly why institutions are watching optical stocks so closely despite the recent poor trading performance that Rosenblatt noted.
Okay.
A days-to-cover ratio of 0.8 means the short sellers are playing a very dangerous game of musical chairs.
Because there aren't enough shares to buy back if the price spikes.
Right. Short sellers having to buy back actual shares to cover their positions could drive the price up exponentially in a classic short squeeze. And the Rosenblatt analysis zeroes in on this tension. The shorts don't necessarily have high conviction in a long-term bear thesis for AAOI.
They're just playing the short-term lumpiness.
Exactly. They are opportunistically playing the volatility around EPS misses. But many of these same institutions fully intend to pivot and go long on optical stocks by 2027 because the macro AI demand curve is practically vertical.
Which perfectly links the financial volatility back to the underlying engineering. The reason there's so much short selling and debate and wildly swinging price targets is that the tech itself is in a massive state of flux.
Yeah, a turbulent transitional phase.
We see this clearly in the CMB International Equity Research Report regarding the rumored delays in co-packaged optics, or CPO, and the 800-volt DC power architectures. The market briefly panicked over these delays, but you see this as more of a timing reset, right?
Yeah, it's a timing reset rather than a demand reset. To
Yeah.
understand why the market reacted so violently to the CPO delays, you have to look at the thermal and latency walls traditional architectures are hitting.
Okay, walk us through that.
Currently, optical networking relies on pluggable modules. You have a silicon processing chip on a motherboard and an optical transceiver plugged into the front panel of the server.
Right.
To send data, electrical signals have to travel across inches of copper trace on the board to reach the optics.
Which generates heat?
Immense heat, and it degrades the signal. Co-packaged optics solves this by moving the optical engine off the front panel and integrating it directly onto the exact same substrate as the silicon switch.
Oh, I see. It eliminates the copper journey entirely. So it is basically the holy grail for reducing power consumption and increasing bandwidth density.
Exactly. But the mass adoption of CPO is now highly unlikely before late 2027.
Why the delay?
The industry is just slamming into near-term manufacturing hurdles regarding integration and yield, meaning, like, how many of these incredibly complex packages actually survive the assembly line intact?
Oh, that makes sense.
And there's also a massive serviceability issue. If a laser dies on a traditional pluggable module, a technician just walks up, pulls it out of the server faceplate, and slots in a new one.
Easy.
Right. But if a laser dies in a CPO setup, you potentially have to rip out the entire expensive silicon package.
Oh, wow. That's a nightmare for data center maintenance.
Total nightmare.
So to make sure you're visualizing this, it's like the industry was banking on teleportation, which is the CPO being ready tomorrow. But because the teleportation machine keeps breaking down, they suddenly have to buy a ton of high-speed bullet trains, the pluggables, to bridge the gap. Does this mean the current manufacturers are actually making more money in the short term because they can milk their existing tech longer?
Exactly right. Because CPO isn't ready for hyperscale deployment, the industry is pivoting hard to near-packaged optics, or NPO, and advanced high-end pluggables.
Well, that works for you.
Yeah, NPO moves the optics much closer to the chip to improve performance, but keeps them on a separate interposer to avoid the nightmare of fully integrated manufacturing.
Ah, bridge technology.
Exactly. NPO offers a practical balance between signal performance and manufacturability, and this is highly beneficial for domestic suppliers like InnoLight, which has a BUI rating, by the way, and the Optolink. It extends the profit window for these traditional module assemblers before the massive paradigm shift of CPO takes over.
Man, it all just feeds back into the same loop. The engineering hurdles force a reliance on existing tech, which drives these massive revenue spikes and wild stock volatility for companies like AAOI and Lumentum, which in turn explains why the raw glass manufacturers in China are running their facilities 24/7 just to supply the physical lanes for all this hardware.
It's all connected.
We spend so much time discussing the software side of AI, the large language models, the generative art, that it's easy to forget the physical reality is a desperate, multi-trillion-dollar scramble for raw glass, lasers, and switches. You simply cannot run the software without the silicon, and you cannot scale the silicon without the optical highways.
This raises an important question, though.
Yeah.
We've spent this whole time discussing the financial and supply chain constraints of these optical networks. But framing this entirely around capital ignores an unavoidable physical reality.
What do you mean?
Well, as we try to pack terabits of data into a single strand of glass thinner than a human hair to feed these AI models, we will eventually hit the nonlinear limits of optical physics.
Wait, really? The physical limits of the light itself?
Yes, it's called the Kerr effect, specifically. When you pump that much laser intensity into such a microscopic core, the electromagnetic field of the light actually begins to physically warp and alter the refractive index of the silica itself.
Oh, wow.
The sheer intensity of the data transmission causes the light to distort its own path. We are approaching the Shannon limit of communication theory, combined with the literal breaking point of the material.
That is wild to think about.
Right, so when money and supply chains are no longer the bottleneck, what happens to the AI boom when we literally hit the physical limit of light?
When the speed of light itself becomes the traffic jam. That is an incredible, slightly terrifying thought to leave on. Keep questioning the physical realities behind the software. Keep exploring, and we'll catch you on the next deep dive.